Hello, everyone, and welcome back to the J22 report. I am your host, Johnnie Market. You all know that drill. Hit that like button and subscribe if you already haven't. Just want to do a quick disclaimer. Nothing said in this video should be construed as financial advice. You want to invest, consult a financial advisor. I am not a financial advisor. Anyway, let's get into today's market. As you can see, big day for gold. Let me share my screen first. Sorry about that. Almost did it again. Big day for gold. 1.38, and silver, outperformed gold today. It's over 31. This looks like it might be the end of the consolidation. So you look at gold doing really well today. Platinum's even doing well. Look at that, over the 1,000 mark. I'm bullish on platinum. I don't know if I did videos, but I like platinum personally. I think it will at least double, maybe even triple from here. Looking at the so that's gold, big day. Looking at the equities, all up. Dow's up 67 points. S&P up to 5,500. Elliott Wave technicians say 6,000. That's probably where it'll go. Not guaranteeing performance, but just my opinion. Nasdaq's up. Look at this though. This is a weird thing about the Dow. 39,000, and it just can't seem to get anywhere over that 40,000. Touched it. Look at 39. This was 39,706. Look at it. This was almost around 40,000. Maybe, who knows? Maybe we'll make a double top, or maybe that's going to be the last breakout. We'll break over 40,000. But even though you hear record highs, the Dow has not been able to make. If you look at it, this is where the Dow is here. If you look at my screen, where my mouse is, right here, and the Dow hasn't been able to make new highs with the S&P. So that is very interesting. I don't think that's healthy per se. But what I think caused the everything rally today seems like is the poor jobs numbers. Let me see. Oh, I don't think I went over the economic data. Let me take a look. US. And I mean, on the surface, it would be strong on a down day, but there's some underlying unemployment rate above consensus. So that's not very bullish, and that's why I think gold's gone up. Average hourly earnings, that's a wash. Participation rate rose, but very minimally. Payrolls, 206,000, but 109,000, but that beat consensus, but unemployment rate rose. And I don't really see anything else. So I'm gonna get rid of this, but look at this. These are two things right here. This is Seeking Alpha news editor. US job growth edges down in June, unemployment inches up. So you can see the mainstream, the normie consensus. This isn't a good job numbers. Payrolls rose by 206, surpassing 109. And a slower pace than the notch of 218,000 notched in May, which was revised downwardly. Remember, they always say downwardly from 272K. And that's what they do. Like, this is no surprise. I wonder what the last month's, this probably 218 is probably below the last month's consensus. So if they reported the real data, they would show that they're not hitting estimates. And that's probably what they'll do. 191K. They'll probably revise it down to like 150. And that's just what they do. The report has notable weakness, which would reaffirm the Fed cutting rates sometime in 2024. Long-term unemployment joblessness for 27 weeks or more increased by 166,000 to 1.5 million. That's up 1.1 million reported last year. Yeah, I definitely sector with the gains. Like we know these numbers are not true. So I don't need to go into that. Even with the most notable downward revision to April and May's job growth estimates, senior market analyst thinks the strength of the job creation could signal inflationary pressures and deter rates. Right? My, you know what? Uh, oh, here it is. Something good. Downward revisions for the previous 2 months take some of the shine off as expected payrolls gain. And yeah, if they keep playing this, the market's going to catch on, I think. If the job market continues to cool, inflation allows the central bank to shift some of its away attention from stable prices, basically from its mandate and of stable prices, quote unquote, and it might start maximizing them. Wage growth pulled back last month, bringing welcoming news to the U.S. central bank, seeing the cool inflation. Wage growth is never a bad thing. Like that's the thing. Wage growth is a good thing because people have more money and people can save. They can engage in activity, and companies don't go bankrupt. Wage price uh, inflation is a lot of different things. It's a psychological carrying mindset. It's an expansion of the money supply. Uh, what's causing inflation is asset price inflation. It is not wage growth. Wage growth is just and you notice how they never hear talk about executive compensation being too high? Like, wouldn't that be considered wage growth? So that's how you know they're BS because the executive compensation is way overboard and that's not cut. That cost gets passed on to the consumer, just like any other wage. So, but yeah, wage growth doesn't. In fact, more productive workers get higher wages. Generally speaking, we don't live in a sane country anymore, so that's not how modern day world, America works. But wage growth slowed, and this is not good. With bankruptcies rising and everything else, wages can't go down. So here, basically, FOMC will lower its benchmark rate by 25 basis points in September. So they're basically saying that there'll probably be one rate cut by September. So yeah, I'm highlighting where I'm reading that. You can read the whole thing if you want. I don't feel like I have to babysit you with I have a smart audience. You all know I'm just pointing out what I think's relevant. And if I don't talk about it in the article, then I don't think it's relevant. Doesn't mean you have to think that way. It's just how I think. And then here's another one, of course. I had to have this stupid ad. So here it is. This one I just pulled. US employers added a solid 206,000 jobs in June. But this is just to show sentiment, how people don't believe these numbers anymore, are starting to question them. America's employers delivered another healthy month of hiring in June. And once again, displaying the US economy's ability to withstand higher interest rates. Yeah. Last month's job growth did mark a pullback from 218,000 in May, but it was still a solid gain, reflecting the resilience of the American consumer, which is slowing but still growing slightly. So even this most report, like bullish report, is even admitting that the economy is slow. Still, Friday's report from the Labor Department contains several signs of a slowing job market. Unemployment rate ticked up from 4% to 4.1. Government revised down its estimate job growth for April and May, combined 111,000 jobs. So basically, that is a lot of people talk about the only two sectors that have strength, so I don't need to really harp on that, but So yeah, if you look at it, even this most bullish article that talks about the job numbers being strong, even they admit there's signs of slowing and job revisions are being down. So anyway, we talked about this and to show that these job numbers, this is one thing that I'm watching for because let me see. But this article here is people are starting to wake up to the fact that these job numbers are BS. June job reports economy creates 206,000 new jobs, but is not as strong as its look. This is market watch. Like, look here, it's market watch. This is not zero hedge. It's not J22 report. This is market watch. So this explains why gold's gone up 30 points despite a strong is the revisions and everything. And it's pretty sad. And Wall Street's going to lose its credibility. How it just only looks at the headline number. It really doesn't dig and make any analysis of the numbers. Because if they did, but it would be one thing. But they just look at the headline number and say the economy's growing. So let's go into articles that show how the actual economy is and why these are more forward looking. We will see a recession within the next year or two, maybe three. Discount real retailer Big Lots to shutter stores may go bankrupt amid elevated inflation. We know there's going to be a crash and a recession because it's every time history. What follows inflation? Deflationary pressures. So, discount home goods retailer Big Lots revealed its plan to shutter more stores this year and may be facing permanent closure. The least major chain to face financial ruin as inflation battered shoppers pull back on spending. Yeah, but the economy is doing great, resilient. Ohio-based company, which has 1,400 stores nationwide, disclosed dismal fiscal reports in June SEC filing. Plans to close 35 to 40 stores following 52 stores closed in 2023. Big Lots reports that elevated inflation puts a damper on consumers' buying power, resulting in big losses for company and substantial doubt about its ability to continue operations. So, yeah, the retailer has been steadily losing money relying on dwindling cash since 2022, raising concerns of bankruptcies. Big Lots did not respond to requests for this comment. So there you go. Big Lots. I know what that store is. Discount. It is not doing well. More news item and major pizza chain. This is MSN. So major pizza chain on brink of bankruptcy. 500 locations risk of closing. So if you look at it, major pizza, Mod Pizza, famed for its build your own pizza options, could be hitting rough financial waters. Bloomberg source suggests a bankruptcy file might drop as early as next week. I see this place all the time. Like when I drive around, I see this place all the time. So could spell trouble for another 500 plus mod location. So I see this place all the time when I drive around. I've never had it before. Maybe I should try it before it goes out of business. But yeah, there's another one, major pizza train. We have Big Lots, and then here is another one. If you think the summer travel season is going to be a big boost, think again. This is Bloomberg right here, right? Oh, Americans say they can't afford a vacation. So here we go. Let's go into the article. Americans crippled by debt and seeing signs of slowing economy. That's exactly what we need. Going back to what the Fed says about wages, when American consumers are in massive amounts of debt, the last thing they need is a cut in pay or lower wages. So anyway, let's go. Americans crippled by debt and seeing signs of a slowing are sitting out on pricey vacations and everyday leisure activities. A bank rate survey found 42% of Americans decided not to take a vacation over the past year because of the cost. Nearly a third said they can afford a vacation less now than they could 5 years ago, though 26% said they could afford to do so more now. Whatever they can afford less. More than two-thirds of US adults opted out of recreational activity due to cost at some point in the past year, a new study found. 40%, almost 40% of the Americans think the economy is not so good or poor. 40% are right. Half of the respondents said the activities they passed on were too expensive to begin with or not a good value. Yeah, there you go. The value customers. If you look at my videos over, they're using keywords instead of saying most Americans are broke. They say they're value customers now. Well, 42% said they didn't have enough money left over after paying everyday bills. And 41 said they wanted to save money for other things. Parents missed out most of all. More than three-quarters of those kids under the age of 18 missing out on activities for 66% non-parents. Yeah. So there you go. Most Americans cannot afford to go on vacation. And then this I just think shows the banks are broke. JP Morgan warns 86% million customers they might have to start paying for their bank accounts. So there it is, JP Morgan. Customers could see some additional charges in the not too distant future. So there you go. They are going to make you pay for your bank account this time. So anyway, those are the big things today. As you know, my macro view, I think the market will go up this year. I think gold will go up. It's an election year. I think this, there'll be, markets are fractal in nature, so they non-linear and fractal in nature. They don't go straight up, so they're gonna have corrections and consolidations. 27 to 3,000 is where I think gold will go. Silver somewhere between 40 to 60. Big move coming, I think, in my opinion. Stocks, it's an election year, but we're gonna see some same thing. I could change, but right now I see stocks going up for 1 to 2 more years at maximum, and then big crash. And not only do they go down, but they stayed out. They're going to be out for the count for about 20 years, and it's going to be really so. Anyway, obviously, disclaimer: these are just my thoughts on the markets, what's going on. I'm not a financial advisor. I can't guarantee performance, and these are just my opinion. You are free to think whatever you want. And just because I think something's going to happen doesn't mean it will. Just my opinion. Anyway, hit that like button, subscribe if you haven't, and I will see you next video, and hope you all have a good weekend.